ครับสวัสดีครับสวัสดีครับ um, hello everybody uh, welcome to our quarterly uh, uh, performance review. um, so why don't we just start off on we're going to be changing the format today slightly. I think uh, we are going to not provide guidance for a few reasons, which we'll talk about in a moment. So overall, let's go through kind of the material things that have happened since the previous quarter. So we're still very much focused on being a ethnic food manufacturer and retailer that is export based. We've got 3 facilities that produce ethnic foods, and then we've got 1 facility that produces pet food, and then we have 1 joint venture that makes plant-based foods. I'm very pleased to say that the joint venture with PDT Group is the largest and only plant-based BRC certified plant in Asia. Now has multiple large companies, including the world's largest plant-based company, as a client. So one of the world's largest, and so very happy with progress there. For the quarter ending March 30th, you can see that when our e-commerce sales have now been dropped off, deconsolidated because we sold the company. The proportion between manufacturing and retail are now almost equivalent, with pet food representing the rest of the product mix. You can see here that we've also now kind of scaled back operationally out of the United States, North America. And over the past 3 years, we've had a larger focus on the UK and Europe, as you can see here. So revenue concentration, I guess if you think about it for better or worse, in this year of geopolitics, probably for better. And why don't we just jump into that? And so if we think through materially what has materially transpired, the first thing is because of the recent regime change in the United States, the reciprocal tariffs have had both a positive and a negative impact on the company. Originally, our view was just all positive, and now it's a little bit of both. And so on the negative side, we're looking at potentially increase in the price that we sell, or the price that our partners, distributors, and retailers in the United States sell our product. On the fortunate side, it's just not us, it's the whole country. And on the benefit side, I would separate it into 2 parts. So if the effective reciprocal tariff between Thailand, Vietnam, and China results in Thailand's effective tariff rate being less than Vietnam and China, then we would be a net benefactor. If it all remains equivalent, then we would benefit relative to Vietnam. We would not benefit relative to Vietnam, but we would benefit relative to China. And I say this because of geopolitical circumstances, we've seen now customers who produce in China begin serious negotiations to move their production to Thailand. So we'll just have to wait and see. I think furthermore, because of the recent change in the administration, we can see three key things that have happened so far. The first thing is, I think there's definitely now talk of the question around kind of ESG and what's going on, disclosure requirements, and basically requirements in terms of packaging, in terms of carbon tariffs. We've been very much aligned with ESG reporting, but I would say the materiality is our added costs for aligning with ESG commitments may not benefit us as much as we had thought from a commercial perspective in the market, and that's because those who don't align with ESG governance practices now may not get punished, and so it becomes an equal playing field. Versus when ESG was a requirement, we felt as an ESG reporting and compliant company, we would have an advantage with supermarkets. In addition, we can see a net benefit in Europe, and so because of the US's position with regards to NATO, the almost trillion euros stimulus package to invest into defense should result in growth in the EU. It should trickle down into improved GDP and ultimately consumer spending. A few days ago, Prime Minister of the UK and the EU announced a new deal, which would see almost the free movement of labor between the EU and the UK, which I feel, in our current view, is a positive because overall labor costs should fall in the UK due to the larger labor base. In addition, hopefully the amount of tourists should increase into the UK, and so that should benefit food consumption as well. And so hopefully that this is a net positive impact in the UK. The second material issue that happened the past quarter is we've had to have 3 bondholder meetings. First one in January, second in February, and third in March. These 3 meetings were called specifically to approve almost basically the same agenda, which was an extension of payments in exchange for an increase in interest rates. It is, without going into too much detail, for non-rated bonds in Thailand, we were advised that almost every issuer were able to receive extensions. However, in our case, we were dragged out by 3 months, and it had a tremendous impact on the company. The first impact was uncertainty in terms of our creditors. Hence, we've had continued liquidity issues as lenders continue to view whether or not we will default on the bonds, which we eventually did on April 20th. The second is our ability to secure additional credit facilities, which we had planned, largely did not come to fruition, and that's because of what had happened on April 20th. And so we're calling another bondholders meeting on the 30th. Each meeting cost us, almost $100,000 US, to basically request a waiver of the covenants and a continued extension. We've had an informal meeting with the bondholders, and those who came showed up. Although not representing the majority, were very supportive as long as they received interest. And so, it's our hope that in this meeting on the 30th of May, that we would get continued support from the bondholders. And so this is something that we have to monitor. So assuming that we do get an approval in May, the move forward plan is in June is we will potentially increase capital in the company to restore liquidity. So that's the plan for June and July. And then in the summer months, the primary focus will be restoring operational performance due to the restoration of liquidity, on the focus on fixing the qualifications from our auditor, our audits. Primarily, our audits, our accounts were qualified, and they were qualified. I'd like Khun Penrai to discuss this. They were the primary reason for the qualification. If you could just do that in like 1 minute.
Which one? I'm sorry.
That's okay.
For the financial report, right? But for the qualification on the scope of the circumstance, due to our investment, right? We have to record as the on the fair value for our investment in the balance sheet, and then auditor didn't happy with we use the management account to record for the fair value, because this one mostly they are the foreign country, especially from the USA, and then under the USA law and regulation, the company LLC, especially LLC, will not have to submit the audit financial report to the government or to the agency. So no one use the auditor, to prepare the audited financial report. So we don't have any audited financial report to show the auditor. So therefore we are not happy with our information. And then this one is a problem for us. Yes, and under we have the qualification under the circumstance limit scope of the circumstance.
Right. So in my own view, we were requested a week before the close of the audit to provide information that was impossible to get, which is basically any investment that we made had to have a full year audit, which was not the practice over the past decade. And it would mean that if you invest into a startup or any company in which the jurisdiction does not require financial reporting, it would mean that you could only invest if that company actually did their accounts. And to do a full audit in the US or the UK, for example, is a minimum $250,000. So our fix, which we're working on now, is to basically pay for the audit for the companies that we invested in, which might take about 2 months and cost around $500,000. And for what reason, I still don't know. But that's the plan moving forward. The remaining in the second half of the year, we believe that once we restore balance sheet liquidity, we should be back into growth mode.
Yeah, then I'm sorry for the investment that we have to just say about that one. Our stake is very low stake, not more than 5% on our investment in the foreign country.
So I'll just do a quick overview. The primary decrease in revenue was threefold, three issues. So the first issue is the Thai baht appreciated by 5% against other currencies. Number two is around 20% of the revenue that was coming from e-commerce has now been deconsolidated because we've sold the business. And then the third is we should have achieved around 10 to 15% more growth in revenue and a higher EBITDA and net profit margin if we have liquidity. And the problem is the withdrawal of credit facilities that impacted our ability to fund manufacturing in the very short term. And so just with that, maybe we just go right into kind of the liquidity issue. And so currently demand orders are greater than our ability to produce. And our ability to produce now has been hampered by financial institutions withdrawing credit lines. And financial institutions withdrawing credit lines is primarily because of the debentures that have come due. So it has been a cycle. So assuming if we get debentures approval on 30th of May, it's very simple. The move forward plan is just basically restore liquidity and then produce what we have in terms of orders to regrow, to go back to growth. You can see here from a revenue perspective that on a year-on-year basis, quarter one tends to be our softest quarter. You can see there. So that's not surprising, but because we deconsolidated about 15% of the revenue, so there's definitely going to be a fall relative to the previous quarter and then relative to the previous year. So wait. I will let the CFO talk about gross profit margin in the beginning.
Okay. Yeah, for the gross profit margin is decreased. You can see for the first Q, the first quarter for this year, compared with last year and the last quarter in terms of the amount, and then this one due to our sale is decreased compared to the last year is our sales decreased, and then secondly for the exchange rate that is Thai baht appreciate, then it's affected our gross profit. Okay, but you can see that the gross margin is with this the decrease from 32% from last year same quarter to 23% from the same quarter, but compared with the same quarter Q4 last year and then Q1 this year is better because of the margin exchange rate is almost the same, but we get the better because of the what do you call the sales the sales mix. For the first quarter we have the higher botany the pet foods business sales, and then the supermarket sale is higher than the last year also. For the term of the year on year, the gross margin is 23, the same with the last year. Yeah, but it's better than the last quarter. And then for the SG&A this month in terms of the SG&A to total revenue, 23% to total revenue is better than it's the same range that it's the same ratio from the last year, but however in terms of the amount is lower than the last year due to the divestment of the e-commerce, and then it's better, and then compared with the last quarter it's going to be better also. For the EBITDA, as we said, the decrease on the sales and the decrease on the gross margin, and then we have this quarter we have the provision of the put option exercise, so therefore we have the negative EBITDA compared with the last year. Only one time is a one time off, so it's made for the EBITDA is negative, and then compared with the last year and the last quarter.
Net profit would basically be
the same things.
So I think if we look at strategically, for the past 3 years, we've had this pivot to Europe. And we did that because we saw Thai flavors are opening up in Europe. There's a market gap for authentic Thai offerings that are clean label, and there's a lot of underutilized flavors that people do not know in Europe, which I include the UK. And there's inconsistent quality in terms of B2B food service. Hence, we pursued this downstream retail strategy of investing into downstream channels in the UK. The opportunity, I still believe the thesis is correct. So, the UK grocery supermarket, for example, is 240 billion pounds. The Asian component of that is somewhere between 1 and 1.5%. And what we find very interesting is TikTok users now are tremendously influential in terms of how people consume and purchase food. And so we believe that we found a strategy that could result in tremendous growth by utilizing digital platforms such as TikTok in combination with our own. So that's kind of a very interesting opportunity. We're also looking at our European growth strategy as one of partnership. So, for example, we used to try to be a manufacturer of sriracha and to compete as a manufacturer, brand owner of sriracha. However, there could be a very interesting opportunity to, for example, even partner or co-distribute, for example, like the world's most famous sriracha in Europe, in the UK, for example, in a combination of sales, in a combination sales platform, which would also benefit our other products as well. And so we're looking at multiple things. I think there's a lot of concern if you read about what's going on in terms of food service. I still am positive, especially despite what people may think of the New Deal between the UK and Europe, that at the very least from a food consumption perspective, obviously more people, more food consumption. So that's kind of where our thoughts are, and I think we're in an area. Our focus is an area that's a bit more stable from a policy perspective. So with that, we're not going to provide any guidance until we have certainty around the debentures. I would say, as management, we're still pretty positive in terms of operations. I think the 1-minute summary is operationally, all our businesses are very strong and demand is still consistently growing. The problem is this liquidity cycle that has impacted our operations. And we still sit on a tremendous amount of assets that we can sell. It's just taking time. And a slide that was not there is we almost have no bank debt. Our bank, since 2023, we have had our credit facilities pulled, and so we paid down bank debt from around $40 million to now it's probably around $6 or $7 million US dollars, which is almost relative to our company, which is around $100+ million a year. It's really not a lot of bank facilities, and so we're quickly moving to a zero debt company if you ignore the debenture holders.